Hello, this is Doug Gerlach from iCLUBcentral and myICLUB.com. Welcome to our Investment Club webinar. Today is November 21st, 2023, and we've got a action-packed, information-filled webinar presentation for you tonight where I will be reviewing the portfolios of 10 investment clubs who have elected and offered up their portfolios for comments on portfolio construction and guidelines and how I believe that investment clubs should focus on building a successful stock portfolio in their club. We've got a lot of material to cover tonight, so let's begin. As always, this presentation is brought to you by myICLUB, which is our tool for investment club accounting and operations, and all of the participating clubs tonight are users of the myICLUB program. During the presentation, feel free to type in your questions during the presentation in the GoToWebinar application. You can also download a handout that includes details on the presentation, the slides, and other materials for your reference. The handout will also be available when we archive the webinar on our YouTube channel. That's iClub Central on YouTube. Now, before we begin, I thought I'd set the groundwork with my rules of portfolio construction for investment clubs. I believe it's a good idea to have specific tangible guidelines that govern your personal portfolio, but equally or even more so for a club portfolio to keep everyone on track with your objectives and your strategies for how you plan to achieve investing success. My first is to get in the market and stay in the market. BetterInvesting recommends that investors remain 100% invested in stocks all the time. And we also believe you don't need to sit on cash. I've had some clubs talk about they like to preserve a 10% or a 12% cushion to cover withdrawals. For most investment clubs, any withdrawals that come up but can be best handled by selling your big losers or transferring shares of big winners. And if neither of those two work, then you can work on other portfolio improvement tactics that will raise cash and not hold back the club's portfolio. So it's possible within your club to be invested all the time in the stock market. As long-term investors, market and economic cycles are opportunities to find bargains, to find potential investments as the rest of the market might be nervous, or as certain companies are responding to the ups and downs of the economic cycle. So we look at those as opportunities, not as risk areas. Most market gains come in just a few days a year. Another reason why it's important to be in the market and stay in the market. And so far in 2023, almost all of the gains in the S&P 500 came on just 6 days. And looking back, you'd be hard pressed to say that you could guess which of those days were going to be the big days if you were trying to move money in and out of the market. But the bigger risk is if you miss any of those days, the more of those days that you do miss, your returns are going to be reflected that omission, the fact that you're not a participant when the market's making its biggest moves. And then when the market is in a sideways or a bear phase, waiting it out is much more efficient and effective than trying to guess when to get in and out of the market. And that's all that it is, an educated guess about the direction of the market on a near-term basis. It's almost impossible to do. My second rule is to keep your club portfolio simple. This is not your personal portfolio. This is not going to have the same goals as many individuals will have in their investment portfolios. So we like to keep things simple and avoid problematic investments, or what we call arcane investments. These provide complicated tax preparation or are not suitable for unit value accounting in an investing partnership. So we suggest that you avoid these whenever possible. These securities that we advise against include real estate investment trusts and business development companies, publicly traded or master limited partnerships, and ETFs, but especially commodity exchange traded funds, those that hold underlying commodities. Those are not treated like investments and from a tax perspective, and so they will create headaches for your treasurer. It's also my belief that you can avoid any ETFs or mutual funds altogether within your portfolio unless you have a specific articulated strategy for utilizing those types of ETFs or mutual funds, and that those advantages are good enough to overcome the accounting issues that holding those types of securities will provide for your treasurer. Now, if you do hold any of these securities here in November, we strongly suggest that you effect a sale before the end of the year so that your treasurer will have headaches for the 2023 tax year, but you'll be free and clear for the 2024 tax year and beyond. Number three, I believe that investment clubs should maintain concentrated club portfolios. That is a relatively few number of well-selected, diversified stocks. My rule of thumb is that you should hold no stock that's less than 3% of your total portfolio value. If you're holding a stock that is only 1% or 1.5% of your total in portfolio value, and that stock sees 100% gain in a month or two, the impact on your portfolio for that massive success is a 1 or 1.5% additional rate of return. So it's simply not worth it to go through the headaches and the hassle of managing those tiny holdings in your portfolio. And another thing to consider is that a portfolio of 20 to 25 stocks will really deliver the optimal rates of risk, return, and risk in a diversified portfolio, especially one that focuses on high quality businesses. If you own more than that in your personal portfolio or your club portfolio, you're effectively turning your portfolio into an index fund. And if you're managing an index fund, you're not likely to exceed the broader market's rate of return. And for all of the hassle that it takes in managing a portfolio of individual stocks, if you've got that many companies, you might as well sell them all and simply invest in one or two index funds instead of managing a portfolio of 40 or 50 or 60 or 100 different companies. Now, if you're a very large club or an investor, you might add more. My upper limit is really around 30. If you look at the best mutual funds in any given year, actively managed mutual funds, you will often find that they are the small funds that have concentrated holdings of maybe 15 to 45 stocks, and that's it. But when you get into the exceptionally large managed mutual funds, they're very popular. By nature of being so enormous, they have no recourse but to invest in the 7 biggest companies on the NASDAQ or the so-called blue chip stocks that have very large market cap. They simply have to because they've got cash, they have to invest it. But if you look at the most successful managers, they will concentrate in many fewer holdings. And I think that's appropriate for investment clubs if your objective is to outperform the market. Now, of course, the number of club members that you have may affect the maximum number of stocks that are covered, but I believe that each member should be able to follow 2, 3, or perhaps even 4 stocks, which means even the smallest mutual fund or investment clubs that we see can manage a portfolio of 20 stocks with relative ease over time. And the other advantage of being concentrated in your portfolio picks is that it forces you to make decisions about whether you truly want to own a security or not. It prevents this sort of, well, let's buy a few shares and see what happens. And we can tell you right off the bat that whenever you do that, one of 2 things will happen. The stock will go up and you'll wish you bought more, or the stock will go down and you'll be glad you didn't buy more. But if you have to make a commitment and invest a sizable amount of your club holdings into new investments, it's going to force you to make sure that they fit with your portfolio and that you are confident in their prospects. And so concentration has additional benefits beyond simplicity of management. It forces you into a framework of thought that will benefit you over time. Now, here's a graph that shows the standard deviation on the left and the number of stocks on the bottom. Standard deviation is a measure of the volatility or risk, if you will, in a portfolio. And it starts with the standard deviation very high with a single stock on the far left. But as you add stocks to your portfolio, the total portfolio risk declines. And you can follow that portfolio risk line until it gets somewhere between the 19 and the 28 on that graph, when it really starts to flatten out. After that point, adding more securities, more stocks to your portfolio will not appreciably reduce the risk level in your portfolio, and it will cause your portfolio returns to become closer and closer to those of a broad-based market index. So that's why my sweet spot is in that 20 to 25, 25 to 30 range. And beyond that, you're really just reducing the returns without reducing the risk. And if you're trying to build a diversified portfolio, we want to reduce the risk, but we also want the opportunity for returns that will outperform the broader market. My fourth rule is diversification. And the first rule of diversification is to diversify by company size. It includes small, mid-sized, and large companies in your portfolio. Now, BetterInvesting defines a mid-sized company as having trailing 12-month revenues between $1 and $10 billion. And from that, you can infer the small company size below $1 billion and the large company size above $10 billion in revenue. Now, BetterInvesting suggests that you target a portfolio that's made up of 25% small company stocks, 50% mid-sized company stocks, and 25% large company stocks. And even if you never precisely achieve this target, this is a good idea to work towards. The smaller companies will give you more return opportunity, and the larger companies will give you more stability over time. Now, if you don't like this approach, you think that small company stocks are too risky, you are comfortable with large cap brand name businesses like every other portfolio manager on the planet, we can't argue with that. There is some truth to it. But on the other hand, if your objective is to learn within your investment club and you want to try to maximize the prospects, then achieving diversification by company size in that range is a very admirable target. Now, here are some characteristics of company sizes. In our iClub tools in the myICLUB website, we define micro companies as having revenues below $100 million. These are much more speculative, very small companies. Occasionally have enough history that allow them to pop up on our radar screen, but often they are more outside the purview of the stock selection guide. The small and the mid-sized companies give you that sweet spot for total return. Here's where we can run under the Wall Street radar a little bit, find undiscovered companies, companies that nobody's heard of, that are doing nothing but making money year after year after year. And we can buy them at reasonable prices and hold them until they become much larger businesses. The large companies, those add stability and dividends, and then the mega companies are the very largest companies in the market. They may often don't have enough growth. They may be more dividend focused and don't often give us as capital appreciation, total return based investors enough oomph to drive our portfolios forward as we'd like. But if you mix these all together in the right proportion, you end up with a portfolio that can be very satisfying. My fifth rule is to diversify by sector and industry. Now, I like to use a framework that Morningstar developed for categorizing companies by a top-level super sector, and there are three of those: defensive, sensitive, and cyclical. And then below each of those super sectors includes sectors, and each of those sectors include industries, and each of those industry groups include companies. My minimum target for super sectors is 15%. Most investors have no problem finding enough companies in the defensive and, in the sensitive and cyclical super sectors, but the defensive sector often seems a little light for many investors. And so setting that 15% minimum, especially for defensive stocks, is a good target to aim for, and you might adjust it to suit your particular preferences. Now, you don't need to include every sector of the dozen sectors that are within those super sectors, but you do want to try to include as many as possible if you trying to match the broader market, the S&P 500, which is designed to match the sector breakdown of the broader U.S. economy. The real estate, the energy, and utility sectors are often you shouldn't feel obligated to include those in a better investing style portfolio. You may wish to include a utility as a defensive sector and capture a little bit of a yield and give up some of the capital appreciation potential. Energy tends to not fit the Better Investing Stock Selection Guide model very closely, and real estate companies, particularly real estate investment trusts in a club portfolio, can be problematic from an accounting perspective. Terrific for individual portfolios, but present some challenges for an investment club treasurer. And then within those sectors, you would include many divergent industries and avoid companies in overlapping or adjacent industries. One example is perhaps investing in a semiconductor chip maker and a semiconductor equipment maker is not the best idea from a diversification perspective, because they're going to be impacted by the demand and where we are in the chip cycle. Perhaps a little bit offset in the timing, but the factors are that impact one of those industries will likely impact the other, at least to some degree. My rule is to target having no industry be less than 3% of your portfolio total value, just like with any single company, or more than 15%. Above 15% in any particular industry or a group of adjacent industries can cause your diversification to not work as effectively as possible. Now, here for your reference are the super sectors: cyclical, sensitive, and defensive, and their component sectors. So the cyclical sector includes basic materials, consumer cyclical sector stocks, financial services, and real estate. The sensitive sector, these are sensitive to the economy, the economic cycles, but not to the degree cyclical companies are. Include communication services, industrials, technology, and energy. And then defensive includes the consumer defensive stocks, healthcare, and utilities. These perform well no matter where we are in the economic cycle, and that can be a good hedge if you're concerned about economic weakness or the threat of a recession. My sixth rule is to keep the focus on growth. I think that having a disciplined approach to your portfolio is key, whether or not it's the Better Investing Stock Selection Guide approach or not is up to you. I believe in the Stock Selection Guide approach and have been using it personally for more than 30 years, but I understand that there are other approaches that can be effective, that will fit your the resources that you have available to you, the amount of time you wish to spend on your portfolio, and other factors. But whatever it is that you choose, however you choose to invest, be disciplined in it. Set up your guidelines and then don't stray from those. And this comes from Mark Hulbert, who 25 years ago, I attended a presentation of his where he talked about the top performing newsletters on his Hulbert investment newsletter honor roll. And our investor advisory service has been on that honor roll for the past 14 years in a row, the only newsletter to be recognized in that period for 14 straight years. But he talked about the best performing newsletters, and some were more technically focused, and some were more value focused, and some were more growth and total return focused. But the thing they had in common was they didn't stray from that particular approach. If you're a growth investor, you don't start speculating in startups. If you're a technical investor, you don't all of a sudden start dabbling in buy and hold stocks. And if you're a long-term investor, you don't all of a sudden decide that one month you're going to start day trading or swing trading. So stick to your approach, whatever it is. Now, Better Investing has three key objectives that they believe are the reason that you can be successful over time. The first is that fundamental growth of companies, that is earnings growth primarily, will drive the price of stocks, will drive the capital appreciation. If you buy a company and its earnings are growing, the price will eventually follow. The second is the value component. If you can buy when a company is cheap relative to its history, to its peers, to the overall market, and then that value returns, you can gain an additional return component. So this is useful during different segments of the market cycle, so that when stocks are expensive, we can be focused more on value opportunities, and when the market is cheap, we can be focused on high growth opportunities. And then finally, the third component is the income that you receive from dividends, which we perceive as more or less a bonus on top of, but is certainly required for large and mega cap companies if you want to outperform the market averages over time. And whenever you stray from these priorities, that leads to underperformance. And one of the big things I see with many investment clubs and individual investors is a tendency to focus on brand names and consumer facing companies, and that limits your opportunities. If you're reluctant to invest in a company that you haven't heard of, even though it's got a great track record, then you're missing opportunities that can benefit your portfolio. So focusing on earnings growth remains a key tenet of the portfolio rules that I'm talking about here. So it's my belief that your club should look at its portfolio like a growth mutual fund and not like some sort of broad-based or target-based fund that has different asset classes included in it, that you really focus on being true to the growth style, a multi-cap growth mutual fund, if you will. You don't have to be like a financial advisor and creating a diversified portfolio for your customer that meets their particular risk preferences. Your objective is to deliver the best portfolio you can for your club members so that they can accommodate their personal portfolio with the club portfolio and make sense of it, so that they know that maybe they're looking for more dividend income or current yield from their personal portfolios, but they recognize they need to have a component of growth over time. And so your club portfolio can be part of that growth component. The minute you start mixing it up and you're trying to create a balanced portfolio that includes dividend payers and you're trying to maintain a cash balance, et cetera, you're doing a disservice to the club portfolio and its potential return. And then finally, number 7 is maintain active management. Too often buy and hold long-term focused investors get a bad rap because they are seen as not being on top of the changes in the companies that they are owning in their portfolio, that they are slow to sell because of their long-term focus. And there is a human tendency at work that makes our brains want to avoid the painful feelings that come when we sell a stock at a loss. So we tend to hold on to underperformers and uncertain companies for too long. And that's something we should be battling against. We should be asking companies to show us the money, or the companies that we own show us the money, or take a hike. And the sooner that clubs and individual investors who use the better investing approach get used to this concept, the better off their portfolios would be. It's better, in my view, to take action too soon or too often rather than wait too late. You keep, and the minute you say, well, why sell now? The damage is done. How much worse can it get? You know what's going to happen? You're going to find out how much worse it can get. So having a strong portfolio guidelines in place will give you the ammunition, the fuel you need to deal with those stocks that have uncertain prospects. If you here we are at the year end, if you're sitting on a stock that you're really frustrated with, that's underperforming in your portfolio, guess what? You could sell it at a loss right now and capture that loss, which will offset any other gains that you've earned. That loss will be distributed to your club members. They can deduct this up to $3,000 of it on their personal adjusted gross income. Right, there are opportunities, and then in a month you can revisit that company and consider repurchasing it after you avoid the wash sale period. Or maybe you've got a stock that you're frustrated with, and you've got another stock that's overwhelmed in your portfolio. It's overrepresented. It's grown to be too big of a chunk. Well, guess what? Now you can sell a portion of it of the gains, trim it down, and sell that stock at a loss, and the two will offset each other. So tax harvesting is really important, especially at this time of year. It's a great time to be thinking about it. And then finally, my advice for most clubs is to utilize the challenge approach. If you're ever sitting on a company and you don't know what to do, it's underperforming, it's not living up to your expectations, just try to find another company, another stock that you like better. Compare them side by side. Use the Better Investing Challenge Tree, which is a free form they make available on their website that helps you to compare two opportunities. And then you can mitigate the pain of regret when selling that losing stock with the pleasure that comes from finding a new opportunity and investing in a new stock. And if you do that often enough, it becomes part and parcel of your tactics for running the club, where you're not going to sit around and wait for things to happen. You're going to make things happen. You're going to find the opportunities, and you're going to put them to work in your portfolio.